Sure. There are a couple risks we think that are kind of embedded in today's market. The Fed is one, and it really comes down to kind of the market's expectation for it might not be fast and furious, but at least a very steady decline in Fed funds rate as we go through this year and into next. And the Fed made it clear that they want to get back to sort of what they would view as neutral. That is estimated to be somewhere close to 3%. But even yesterday, Chairman Powell sort of threw a bit of cold water on the notion that markets should expect a predetermined trajectory to that neutral rate, and that they will continue to be beholden to data. Now, the data they're focusing on is a little bit less on the inflation front, a little bit more on the jobs and economic front, and so Friday's payroll number becomes very, very important. See, the estimates seem to be somewhere between plus 140 to 150,000 jobs created in the month of September. Anything close to that would sort of keep the Fed on track for modest sort of reduction in rates, but would not put any pressure on them to accelerate that. The market is pricing this move in a very linear sense and also at a fairly rapid sense. But policymakers haven't really given us any confidence or indication that they're ultimately going to move at the pace that the market's pricing or as quickly, and that they're going to likely have to respond. Now, they may ultimately move faster depending on what's happening, but our view at this point is that the Fed is going to go slow and steady, that they're going to need to preserve both their inflation-fighting credentials and firepower. In the absence of an economic collapse, there's no need to sort of rapidly accelerate or dramatically move rates lower at a fast or accelerating pace. So
George,
there's a little bit too much cooked in at this point.
It's interesting, isn't it? In the last 24 hours, the inflationary bugbears just seem to have come out of the cave. So there's a lot of dissonance now in terms of the inflationary and the deflationary picture. Just turning to the payrolls once again, the consensus is for 4.2%. What if we see an upside surprise there on unemployment? 4.4, 4.5?
Yeah, no.
Yes, that's right. What happens to bond markets then?
Yeah, no, it's sort of an interplay between job creation, unemployment, and average hourly earnings. Sort of if the trifecta rolls over and it's all coming down, then bond yields go lower and the Fed sort of put, if you will, goes up in value. But you're likely to get kind of still a mixed bag of ongoing sort of earnings gains at a fairly modest pace. Unemployment's expected to be unchanged, and then there's sort of the wild card of where job creation ultimately shakes out. It doesn't look as if all three factors are going to be rolling over and trending lower at this point. So from our perspective, bond yields are pretty fairly valued. Let's say set 3 3/4 on the 10-year, is not a terrible fair value sort of level for rates at this particular point in time. We don't see a reason why rates need to kind of come down dramatically, unless we're wrong on the economic front and we do start to see some material deterioration. I think the greater risk here in the U.S. is that maybe inflation could start to peak up a little bit as we go forward. That's not in the prices, but that is something that we need to keep a very close eye on.